With massive layoffs in nearly every sector, weakness in manufacturing, car sales and housing, and the biggest one-month decline in the trade deficit since the financial crisis, the economic picture is not looking good, which might explain why so many billionaires are loading up on gold, including hedge fund manager John Paulson and real estate mogul Sam Zell. Bottom line, now is the time to own gold, which is why the experts at Stansberry Research just stepped forward with a major gold prediction, arguing gold could soar as high as $3,000 by the end of the year, possibly even higher. You can find out why and get instant access to their #1 gold investment today. It's not bullion, an ETF, or a mining stock, but in the past, this gold strategy could have made you nearly 50x your money. Considering how quickly the price of gold has been moving in recent weeks, you don't want to waste any time missing out on the gains these experts believe are in store for this gold stock. To get a copy of his new free report with all the details, simply go to goldmaniareport.com. Again, that's goldmaniareport.com for a free copy of his new report. Hi, this is Daniela Camboni, and welcome back to the Daniela Camboni Show here on Stansberry Research. Joining me today is Matthew Piepenburg. He is a partner over at Matterhorn Asset Management. He's also the author of 2 books, Rigged to Fail and Gold Matters, Real Solutions to Serial Risks. And you better believe I'm going to be talking gold with Matthew. But first, we are speaking ahead of a very important Fed May meeting and during a blackout week for the Fed. The U.S. Federal Reserve is likely to deliver a 25 basis point interest rate hike, then pause for the rest of the year. This is according to a study recently done by Reuters of various economists. But we're going to get my guest take and so much more today. Matthew, so nice to have you on the show. Finally, good to connect.
It's fantastic to be here. I'm looking forward to this conversation with you a lot.
Me too, because the Fed is just, the tip of the iceberg of what we're going to be talking about today. But, not to spend so much time on it, but I guess my biggest question, rereading their minutes from the March meeting, I mean, they're just basically not giving us the truth about what's happening in the economy. And I know you have something to say about it, but what do you think they're going to do here?
Well, I mean, they kind of telegraph what they're going to do. I guess, the Fed always fascinates me. They use a lot of lofty platitudes to hide really, really bad math. And they've been doing it for years. That's what they have to do because the Fed, although independent, is really a political beast. It's a creature from Jekyll Island. But, they have to position themselves as being tough on inflation. And there's still this argument that they're going to fight inflation with rising rates. And but because of the recent banking crisis, the regional crises in the US, and because of the strong dollar of 2022, I think they're realizing they're going to have to raise one more time, 25 bips. I was surprised they would, but they probably will. You can never underestimate the Fed's capacity to do the insane. But it looks like a 25 bip hike and then a pause for a while. And they'll see how the markets react. Again, we can only wait and see.
Well, so basically, do you think they're satisfied with what they're seeing on the CPI front? And 2, I knew you were coming on, and I know back in September, you were saying, look, the Fed, Powell, actually needs inflation to fight debt. So they were almost begging for inflation. Do you still stick to that?
Look, I have a somewhat contrarian view. I don't think you're ever going to beat monetary-based inflation. I mean, to me, inflation is always a question of the purchasing power of the main currency and the money supply. And even though we can talk about money supply, and we shall, I never thought that Powell's motive was sincerely to fight inflation. I think the Fed needs inflation to inflate away debt. They need negative real rates, which is obviously good for gold, which we can talk about. But they need inflation to be higher than the yield on the 10-year for a number of reasons. Because deep down, they're trying to debase the currency to partially inflate away this extraordinary debt. And I think the narrative that they're trying to fight inflation, the narrative that that Powell is a Volcker 2.0 is totally specious. I mean, again, remember when Volcker was Fed chair and he raised rates significantly in the late 70s and early 80s, U.S. Public debt was less than $1 trillion. It was $900 billion. At 34 trillion by the end of this year, Powell can't be a Volcker. We can't raise rates to the point where we absolutely destroy the bond market and put ourselves at risk of real constructive default. So I think the real reason Powell's been raising rates throughout 2022 was the same reason he tried to do it throughout 2018. He sees a recession coming. He sees a market implosion coming. He needs to get his toolbox reloaded with rising rates now so it has something to reduce when things really hit the fan. I really believe that. Again, it's not the official narrative, but I don't think the official narrative from Powell has ever been truthful, right. Whether it was transitory inflation, that was not truthful.
Exactly.
I don't think Nixon's desire to go off the gold standard was temporary, was going to be truthful. And I don't think this war against inflation is truthful.
Why can't they just be truthful? Why can't they just come out and I'm not saying they aren't or whatever, but why can't they just be completely transparent? What is their fear there?
Well, that's a question.
Being wrong?
That's a fantastic question, but that's true of all politicians. There's almost a will to power that would make Nietzsche blush, whether you're a politician or a Fed chair or an FOMC member. There's a need to stay in power. There's a need to galvanize power. There's a need to look good and avoid transparency, candor, bluntness, the kind of things we all do at a business meeting, at a board meeting, or at a family dinner about our budgets. I think the Fed has been a complete failure since its inception back in 1913. It hasn't prevented major recessions. It hasn't prevented bank runs. It hasn't prevented collapses in markets. It's really created its own centralized control where they're the portfolio manager over our economy. They're just a very bad active manager. And the real question isn't what's needed to keep the Fed in power. The real question is, why do we even have it? Of course, it's too late. It's a fait accompli. It's here. But I think Fed chairmen, Fed chairwomen, remember, it wasn't that long ago that Janet Yellen said we may never see another recession in my lifetime. When Powell said 2 years ago, in 2019,
right.
2008, I mean, they've said so many things that are just patently untrue. They were completely false and completely 180 degrees the opposite of what transpired within 6 to 12 months thereafter. The record of honesty and the record of forecasting from the Fed is literally one of the worst on record. And yet, we still hang on every word. We still wait for the Fed to decide our fates, to decide the fates of the bond, the credit markets, and frankly, our very basic economy. So to your question, why can't they be honest? I would ask that to a senator, a congressman, or any member of the White House, left or right.
I just want to share a quote from a recent article of yours where, speaking about Fed quantitative easing and quantitative tightening, you say they're more than just words, experiments, or theories. They are unnatural, artificial, and powerful toxins which can't be contained to just making central bank balance sheets thinner or fatter and bogus CPI data higher or lower. So, wow, what a loaded statement. First of all, bogus CPI data. What do you mean by that?
Well, look, we all know that
well, I know what you mean by that, but
it's just another example of words replacing math. Platitudes replacing honest numbers, and math is more honest than politicians or central bankers. I mean, everyone on Wall Street and everyone listening already knows that the official CPI scale, I've always joked, is as bogus as a 42nd Street Rolex. It just is. I mean, if you use the same scale that Volcker used in the 80s, we'd have inflation twice as high as officially reported. And the Bureau of Labor Statistics has a fantastic group of fiction writers in DC who create reverse engineer math to make inflation look a certain number. Again, they have their cake and eat it too. They want inflation to inflate away debt, but they can underreport it by 50% so that their policies don't look as ridiculous as they actually are in true mathematical form. So again, it's a history of non-transparency. It's a history of duping. It's a history of using words, again, to replace math. And it's a history of poor forecasting. And it's a history of being disingenuous because, again, I think the real aim here is to seek inflation and then to puff their chest to fight inflation in public, but to need it in reality, and then to misreport it. And of course, again, it's the same thing when they misreport the definition of recession. They changed that midstream last year, changed the goalposts in the middle of the game. They say things like we'll never see another recession when that was clearly wrong. They'll say things about the CPI scale that are clearly wrong. But, the Fed is never honest, but it's always right because it's the Fed. And whether we agree with it or not, it is the official CPI scale that markets use to measure real rates and negative rates. And so whether they're honest or not is kind of relevant now. We know they're not honest, but it is the marker that the rest of the market has to use. And CPI can go up and down, real or misreported. It can go up and down in dramatic swings. It doesn't change the fact that the Fed, since its inception, has completely distorted price discovery in America. It's destroyed capitalism. It's created massive market bubbles and the greatest wealth equality in the history of our country. So this beast that was kind of incepted in 1910 and then became law in 1913 has left nothing but a trail of tears for real market, real capitalism. What we have is Wall Street socialism that benefits the top 10%, which get 90% of the inflationary bubbles in risk assets. It's kept Fed shares in power. It's kept politicians elected. It got Bernanke a Nobel Prize, but it's actually destroyed the Main Street economy now. And it has completely distorted capitalism because we have a Fed-driven market. We don't have natural supply and demand. We don't have free price discovery. We have Wall Street socialism and Main Street feudalism. Main Street feudalism. We have serfs and lords now in America and in Europe.
Matthew, I want to transition now to your most recent article where you take a deep dive into cracks that we're seeing in the petrodollar. The main point I want to raise here is you say this is by no means the end of the US dollar as a reserve currency, just a slowdown of the USD as a trusted, used, or effective currency. What do you see happening on the de-dollarization? What's your theory here?
Like, it's a watershed moment. And de-dollarization, there's a lot of different views on this, Brent Johnson to Alistair McLeod, and they're all very, very intelligent arguments with very informed opinions. I do agree that the world reserve currency is not going to change. The dollar is not going to not be the world reserve currency anytime soon. It's still there. It's 60%, US dollar is 60% of the global currency pool. It's 40% of debt settlements are denominated in US dollars. So it's not going to go away overnight. What is changing is the hegemony, the respect and trust for the US dollar as a payment system. It's a critical difference between being a world reserve currency and a payment system. And the truth of the matter is the world is breaking ranks with the US dollar. Again, that doesn't mean the end of the US dollar. It's not going to be replaced by the ruble or the yuan tomorrow. Absolutely not. The Chinese bond market, the Chinese currency, the yuan, is not stable enough to replace the US dollar. And it's the US dollar is too deeply interwoven into the derivatives market, the euro dollar market, the very things that Brent Johnson has talked about. And I met him in Zurich, and I agree with a lot of what he says. I think the de-dollarization process, though, is happening faster. It's like Hemingway's definition of poverty. It starts slowly at first and happens all at once. What happened in 2022 with the war in the Ukraine, the Western reaction, those sanctions, had a massive ripple effect. Basically, the West shot themselves in the foot. And as Grant Johnson and I said back in March of 2022, I think what happened in March of 2022 with those sanctions, freezing Russia's FX reserves, taking it off the SDR, taking away from its SWIFT account access, was giving Russia and China the opportunity of a lifetime to de-dollarize. And the BRICS and other nations, 41 nations now in bilateral agreements outside the US dollar. There's a massive move away from the dollar. The dollar was too strong going into the war. And then when they weaponized the world reserve currency to freeze FX reserves of a major country like Russia, again, this isn't Venezuela or Iran, this is Russia. That created a moment where everybody raised their eyebrows and said, do we trust this US dollar? Can we find now the pretext to get away from it? And that is exactly what's been happening at a rapid pace since March 2022. To what I was going to say, right. Grant Williams described it as as big a moment in the currency markets as August of 1971 when we decoupled from the gold standard. It is a major, major event, and it's going to have tremendous consequences, of which the petrodollar is just one of many examples of a slow movement away from the US dollar as a controlling hegemonic currency. The Saudis are looking at the yuan now. They're looking at Mexico. They're looking at other countries. Right. They can use the yuan to hedge back into gold. They can buy, they can do deals in yuan and then hedge into gold. Remember, when we got the petrodollar status in the 70s, it wasn't a foregone conclusion. This is something that Lou Groman and Rutherglen have talked about. It wasn't a foregone conclusion that the dollar would be the petrodollar, because at the time, the U.S. Treasury wasn't trusted. We just decoupled from gold, but Volcker raised interest rates up by 15%. That made the U.S. Treasury and the real return on the U.S. Treasury more sexy. But again, Powell can't do that now. We can't raise rates by 15% to get OPEC to think the dollar is a strong backing for oil. So there's lots of distrust politically and in the currencies against the petrodollar. That, again, will not happen overnight, but it's happening. It's happening. There's bilateral agreements outside of the dollar happening everywhere, and it's going to be a watershed moment.
I'm going to go back up to your point about right now there is no direct threat to the U.S. dollar being uprooted as the reserve currency. But what about, we hear that the BRICS want to develop their own currency. Like, can't it be a basket of currencies if another one like the euro or the yuan is not strong enough to go up against the dollar? Yep. What happens if it were a basket?
Well, that's what's happening with the BRICS right now. And there are a lot of things happening off the radar, under the radar, and in the headlines. I mean, again, you've got to think about, there's 30 trillion in US dollars in the world, held outside of the US, and about $6 trillion in cash, another, I think, 13 trillion in portfolio assets. The rest are in US treasuries. But foreign central banks and foreign nations have been dumping U.S. treasuries throughout 2022. And the U.S., ironically, households are buying them. We can get into that in a second. But there's been a massive dumping of U.S. treasuries because Powell's rate hikes have made the dollar too strong and too expensive and too painful. $14 trillion in foreign debt has to be paid in U.S. dollars. As Powell raised the rates, it made the cost of that debt more and more painful. And so these countries like the BRICS, but Ghana is now selling oil in gold rather than dollars. Its inflation has gone from 160% to 60% because it's a better inflation fighter to sell in gold than dollars. Mexico is talking to China about yuan-based settlements. There's 41 countries right now. They're doing bilateral agreements outside of the dollar deliberately because the dollar became too expensive. And there's some backdoor QE among some of the other central banks. This is something that Kathleen Lloyd tweeted about last couple of weeks. Without the Fed having to mouse click money or reduce rates and weaken the dollar overtly, other central banks have been buying each other's debt. It's by doing each other's QE for them. So FX reserves in the yuan, in the yen, in the euro, and in the pound have gone up 10, 7, 8%. The dollar got 11% weaker, not because the Fed pivoted, but because other central banks did a coordinated effort to QE each other. So it was backdoor QE to the tune of about $100 billion a month. There's all these tricks being made to weaken the dollar without the Fed having to pivot yet. But the truth is, by raising the dollars, the interest rate on the Fed funds rate, making the dollar more expensive, was a slap in the face to developing economies which for decades have been bullied by a strong U.S. dollar. They're all looking for a pretext to get away from the dollar. And that does impact the ultimate demand for the dollar and the strength of the dollar, especially when the petrodollar becomes under threat. Then you're really looking at less and less demand for that dollar, despite the milkshake theory, in my opinion.
But the U.S. is obviously seeing this unfold, right? So what tools could they use to counter this, or is it out of control at this point?
Well, this is something we talked about before the interview. There's a finance minister in Russia, a guy who's, we can read his white papers. We don't know the official stories that are coming out. I talked last summer about the Moscow World Standard and this new LBMA exchange for gold, but it's deeper than that. Countries like Russia and China have been watching the West in general, and the U.S. particular, just kill themselves with debt. They're chess players. They're 5 moves ahead of the U.S. in terms of what the debt consequences are. And again, debt always destroys nations. This is something from David Hume to von Mises to Thomas Jefferson to Andrew Jackson to, frankly, Woodrow Wilson. We all knew this, and we're at that turning point. But this fellow Glassiev in Russia, they're already working right now on a trade settlement currency that we don't know officially, but it's almost, and I don't want to speak out of turn, but it's pretty much understood that that's going to be a gold-backed trade currency. And when that happens, that's going to be a revolutionary moment in global currencies. And to your question, what is the U.S. going to do about this? Well, this goes back to Hemingway's comment. What does a debt-soaked country always do? It debases the currency, it has higher inflation, and it goes to war. And now we've got a blue water navy, we've got a proxy war in the Ukraine, and we're thinking about a war in Taiwan. This is the question, this is the thing. Again, I'm not trying to take a stance on war, pro-Zelensky, pro-Putin, or China, or trying to be non-patriotic. But war as a policy, war as a distraction, I don't think any of us, whatever our views on war, and certainly our views on American men and women, or any man and woman fighting on any side of any war, we don't want to see more death, but none of us want to see our families radiated over Taiwan to the Ukraine. And the question is, as this new settlement currency comes out, as the East rises in prominence, as currencies go into more gold-backed direction east, why central banks are buying more gold in the East, as there's a paradigm shift, are we going to distract ourselves, which is what America does, distract ourselves in war like Hemingway warned? Are we going to allow in a nuclear era the risk of war over Taiwan and the Ukraine just because Russia and China are now thinking about an actual gold-backed currency as we look towards central bank digital currencies and more farces? And that'll be an interesting thing that no one can predict the ramifications. There's so many domino effects that stem from our massive debt problems in the U.S. and in the West in general. Massive.
Let me play devil's advocate for a second, Matthew. So to the folks out there who will say, okay, great, Russia wants to develop a gold-backed currency. That's why they're hoarding gold. China is buying gold. We see the numbers. They want to develop a gold-backed currency. Let's say even if Russia develops, the equivalent of the London Bullion Market Association. We saw those rumblings in the fall. A lot of people will say, who cares? It's not a big enough market. Who cares if Russia is doing this?
Well, it's a fair point. This is the cognitive dissonance that we all have a bias. I grew up in the U.S. and in Europe. I have two views. I have a strong bias towards America, and yet at the same time, I'm very critical. I can afford to be critical because I can see it from many different perspectives. And this is going to the earlier point.
Right.
It's not the end of the world reserve currency, but it's a slow drip away from trust in a dollar that's backed by nothing. Because banks are not about money, they're about credit. And credit is anchored in money that is anchored in nothing. And the West doesn't seem to get the fact that that has ramifications that ultimately destroy the country from within. And the East, again, I'm not looking to be under the rule of a Russian system or a Chinese system, but they are seeing the economic realpolitik that this fiat game is not sustainable. This debt game is not sustainable. It ultimately destroys the currency. You can't keep solving a debt problem with more debt solved with money printed out of nowhere, mouse out of nowhere to solve that debt. Trust in real money is disappearing, which is, again, there's a slow move, slow and sure, to the east, towards more gold-backed, towards more real money assets, and towards a more fair exchange, not just in gold, but actually in currencies, a drift away from a fiat system that has failed.
How does all this tie in to central bank digital currencies? Does it?
It absolutely does. And this is something I've said in interview after interview, and it's not just a bromide, it's not just a syllogism, it's an historical fact. Whenever you have a country with its back against a debt wall, this is throughout history, it goes from ancient Rome to the 1930s to today, any country that's got it's in a debt corner that it can't solve will always have a market crisis, an economic crisis, a currency crisis, an inflation crisis, which leads to social unrest and then more control from the extreme left or the extreme right. Central bank digital currency, the slow trappings of it that are coming out now with the FedNow, the icebreaker at the IMF or the BIS and this universal monetary unit that you and George Gammon had spoken about. These are all just slow drip versions towards more and more centralized control. And centralized control in this form of CBDC is just an extension of this domino effect that I talked about before the call. You have a bond crisis right now because we have a debt crisis. We have a debt crisis because we have twin deficits. We're looking at 50%. Our U.S. deficit is 50% of global GDP. Our tax receipts are down 10% year over year. Our true interest expense on our interest is already going to be $800 billion. We're going to be raising our deficits further. So we have a debt problem in the U.S., which is now showing itself in a bond crisis. And this is now, and we can get into, in a banking crisis. We don't have time to go into all these individual stovepipes, but they're all related.
Right.
But as we go from a debt crisis to a bond crisis to a banking crisis, we need some type of centralized control. Right now, the FedNow program or this, universal monetary unit or this icebreaker that's at the BIS, the IMF, and the Fed, that's not central bank digital currency right now. That's digital SDRs that banks can use to use digital transactions among themselves. But it will be a slow drip toward the point when there is a crisis, and this is how it's like a PSYOP or a covert operation. This is how the Fed and DC works. They've slowly telegraphed CBDC since 2020, kind of hinting that they're going this direction. And they're talking about all the warm and fuzzy aspects. You're going to get faster payment systems. You're going to get better loan terms. You're going to have no bank runs like we saw at SVB recently. We're going to be the bank that cannot fail. This is going to be so great, but they're going to wait. They're going to wait until there's a real crisis to bribe you with lower rates, better terms, safer banking through CBDC, just like we saw during the COVID crisis when we had no real choice. If you worked at Goldman Sachs or Citibank and you didn't want to get the vaccine, you didn't have a choice. It was either your job or the vaccine. So it wasn't really a choice, even though you have free choice in America. When we have a real recession, a market tanking, currencies losing, inflation spiking after a deflationary event and a market crash, the Fed will come out with this great solution. We're going to just put your deposits at the Fed. Your dollar will now be a liability of the Fed. It's a much safer bank. And we'll be able to control bank runs and give you better terms. There really won't be a choice, though, because at that point, the vast majority of Americans aren't going to understand that this is really a control mechanism. It's a Trojan horse masquerading as an efficient payment system to get people to just agree. Just like we agreed to a vaccine. If you worked for a large bank, you had no choice. There really is no choice. The question is, in between now and that watershed moment, will more listeners, more viewers, more people, more Americans, more Canadians, more individuals see the forest through the trees here and see what the real play is? Because what they're really looking for is global control of the currencies.
You mentioned Gammon, and something interesting he brought up for me was that it's actually illegal for the Federal Reserve to issue a central bank digital currencies.
And this is per the Fed. So per the Federal Reserve Act, the Fed is not allowed to do business with individuals.
I didn't know that.
Well, yes and no. I mean, I love the rebel capitalist. It's the Virginian in me. I love the name. I love his thinking. I love all that he's doing to educate. He's right in a sense. The Fed doesn't have the right to do business with individuals. But the Fed, in an emergency, in a national crisis, like a major recession that makes 2008 look like a choir practice, in a national emergency, the Federal Reserve Act can be modified. But more importantly, yes, the Fed cannot do business with individuals, but putting on my lawyer hat, they can do business with other banking institutions. They can do business with JP Morgan or Goldman Sachs, who can then take their depositors' money through their bank and park it at the Fed like they do their treasury. There'll always be a way to get around the Federal Reserve Act in the name of a national security or for your own good, just like the vaccine was for your own good. They'll always find a way.
Let me ask you this, because I'll fault myself for this, that yes, I spent a lot of time on this program talking about the dangers of the coming central bank digital currencies and what it will mean for our privacy and whatnot. And a lot of my guests will say it will be the end of humanity at that point. Could you see any positives of having a central bank digital currency, or is it really just a nightmare scenario for you?
I honestly see it. Again, it's sadly history repeating itself. The more things change, the more they stay the same, right? We joke here in Montreal, le plus ça change, le plus c'est la même chose. This is just history repeating itself. This is debt broke nations taking no accountability, destroying the middle class with the invisible tax of inflation, bribing them with safer transactions, less bank runs, better interest rates, better terms, but not telling them the full story, that this is about being able to control your currency through our central bank, which we then, under the full control of the BIS and the IMF, get more global control of currencies, certainly Western currencies, so we have something to fight our non-military financial war against the East in countries like Russia and China, which are rising. China has a population and industrial revolution on its way. It's industrializing at a faster pace. Again, I'm not anti-American, but a debt-soaked America cannot compete with an austerity-driven China and an austerity-driven Russia that plays for the long game. And so it is a nightmare scenario for me. It is absolutely a nightmare scenario. The question should not be, why shouldn't you all be at a central bank like the Fed where your deposits can be safe? Because we're a bank that cannot fail. That's better than SVB. The question should be, why do we even have a central bank centrally controlling our markets, our natural supply and demand, and our free choice? Why do we have a government in Canada or the US telling us what to do with our bodies or our money? That's the real question.
So Matthew, how far out is that reality? I mean, how far are we from a true CBDC in the US?
I think it's a question of how far out we are from a true market crisis, because this is going to be introduced at a convenient time for the powers that be, for the central banks in general and for the Fed in particular. And so that will be SVB or Silicon Valley Bank or Signature or First Republic was just a small taste of the kind of banking and financial and market crisis that's coming ahead. Again, the market's already priced in a rate cut this year because they see a market disaster at some point. And I think when we have another moment, another 208 moment, another March of 2020 moment, because there's been so many credit event cracks. We had the repo crack in 2019. We had the U.S. Treasury crash in March of 2020. We had the gilt implosion in October 2022. We had the regional banking crisis in March of 2023. When we have another 2008 type crisis, another 2020, March 2020 crisis, that's when the Fed will come up with this miracle solution for your own good, this type of financial vaccine for your own good. Trust us, this is going to be great. It's going to be fast, efficient, safe, better rates, better terms, less bank runs, less fears. So the question isn't timing it for Q3 or Q4 of 2023 or Q1 of 2024. The question is when things break again. There's been so many cracks in the ice, as we just saw that last string site of credit event crashes. And Silicon Valley Bank was just one, much more to come in the banking system and in the bond market system. So I think when that crisis comes, Daniela, that's when they're going to come up with this miracle solution, this financial vaccine, which will be ineffective and more controlling.
So I'm happy you brought up the banks and the crisis, obviously, and you've done so much writing on this. You say that there's more systemic risk in the banking sector to come.
Yeah.
So let's get your thoughts on what is an everyday person supposed to do faced with the banks today. Should we trust them? Is our money safe?
Well, look, I mean, it's more than a moral hazard. I mean, the truth is they can't allow banks to fail. That was not a surprise to me, because if banks start to fail, that has a contagion effect that loses faith in the whole system. So forget the moral hazard. We live in a fiat system. Banks can't be allowed to fail. What they'll say, though, is next time there's a major bank failure, we're going to have to probably centralize this into a safer bank like the Fed. That's the greatest irony of all time. It's a controlling bank, not a safer bank. It's not even meant to be, in my opinion, the constitutional legal bank, but that's a separate issue. What we're seeing in the banking system right now, though, is we're seeing this bank crisis at SVP was ironic because it was a failure not only of their loans, but it was a failure of their underlying collateral, their U.S. Treasury book. But that was ironic in a sense because banks like SVP, regional banks in particular, were buying bonds at the top, the opposite of what any investor is supposed to do. You're supposed to buy low and sell high. Because of years and years of repressed rates and QE and a bond market bubble, banks like Silicon Valley Bank were buying U.S. Treasuries at the top. So when Powell raised rates, bond prices fell, collateral fell, and banks started. There was a run on banks because there was a failure and trust in their collateral. So banks bought at the top rather than the bottom. But the real problem we're seeing here is money supply contraction, M2, M3, which is a symptom of credit contraction. And credit contraction has an impact on bank lending. And what we're seeing right now is obviously M2 and M3 contractions, but banks see risk. Whether it's JP Morgan with trillions in deposits or whether it's a smaller bank in California or somewhere in the middle in Omaha, Michigan, or Tennessee, banks see risk. There was a reason other banks didn't bail out SVP or give them discounted loans to keep their books alive. They don't trust the banks. They don't trust the economy. They don't trust the loans. And what you're going to see now, and what we are seeing with the credit contractions, because you're seeing, look, there was 180 billion in investment grade bonds issued last March. This March there was 60 billion. Last March there was 24 billion in junk bonds issued. This March there was 5 billion. There's less issuance, there's less credit, there's more contraction. But more importantly, banks don't make as many loans to speculators to buy back their own shares or companies. And more importantly, perhaps most importantly, banks don't trust each other. They're not making loans to each other. They have a list of which banks they're going to trust to take money from or to give money to. That's something that's not spoken about in the headlines. But this credit contraction, this distrust among the banks. Again, you have to go back to the repo crisis of 2019 to remember, banks didn't trust each other's collateral. So the Fed had to come and be the lender of last resort because natural distrust, natural balance sheets, natural supply and demand, and natural constructive destruction of bad banks was not allowed. Now we have centralized control. But the real problem we're seeing in the banking crisis right now is a treasury crisis, which is based on a Fed crisis, which is because of a bond crisis, which is because of a debt crisis. It's all related to debt. But what you're really seeing is banks they don't trust each other's collateral. They don't trust each other. They're not lending to you and me, and they're not lending to other banks. That's a seismic shift in the banking system, which again could be saved if you had a centralized bank like the Fed under a CBDC regime. But keep in mind, as George said in your last interview, the last time you had one bank centralizing control over all these little offshoot banks, where all the control came from a centralized bank, was Soviet Russia. That was not capitalism. Mm-hmm. We are pretending to be capitalism. What we are is a facade of capitalism with Wall Street socialism, where the central bank controls the too big to fail banks, which are too big to fail, which in turn become branch offices of the Fed. And then once our deposits become owned by the central bank or the Fed, it's game over. It's game over.
Well, this is a perfect segue to get to your bigger thesis here as to why all roads always lead to gold. Why do you see gold as a solution against this monetary beast we're facing?
Well, because the real problem underneath all this debt crisis that leads to a bond crisis, that leads to a banking crisis, that leads to a currency crisis, is because our currency is backed and anchored by nothing but the trust and full faith and credit of our government. And our government is over its skis in debt. Again, running twin deficits, 95 trillion in combined household, public, and corporate debt. We've been living beyond our means and putting everything to stay elected or to get a Nobel Prize for Bernanke. All that's been bought by placing the bill and kicking the bill down the road to the next generation. We're living beyond our means. Our currency is anchored in nothing. There's no real money in a $10 bill or a $100 bill or even a dollar bill if you can find one. And I think the faith in the U.S. government. Remember, when the U.S. dollar became the world reserve currency, that came after Bretton Woods in 1944 when our dollar was backed by gold. We lived for over a generation on this U.S. dollar backed by gold. But in 1971, Nixon welched on that. 50 years later, we're starting to finally see the consequences of that welch. Because in that same 50 years, not only do we not have a dollar backed by gold, we took our debt levels to levels that were inconceivable. We have not had strong financial leadership in the White House, the House, or the Senate. Because sadly, most politicians, left or right, since Eisenhower and Truman, don't understand balanced budgets, don't understand the consequences of fiat money, don't understand the dangers of mouse click money. I said in a report I did, and you can see online, it's the Faces and Cycles of Gold. This happened in 1789 France, the once most powerful country in the world. Over skis in debt, too many wars, problems at home, problems in the market. Their solution was to print money, and it ended in a disaster. It ended in Napoleon. It ended in more centralized control. Weimar ended in Hitler. Mussolini came after inflation in Spain. Franco came after, in Italy. Franco came after inflation in Spain. Every debt regime in South America that went to a more controlling economy came after inflation. We're going into a debasement of our currency, as Hemingway warned, inflation, a war cycle, because we have a fiat currency anchored in nothing and no one trusts it. This goes to your question. Gold is, whether we like it or not, a monetary metal. It's different than other commodities. And the world, and I hate to say it, the East has known this longer than the West has tried to pretend it isn't a problem. Now the problem is becoming insurmountable. Inflation is palpable. Social unrest is real. It's financially driven. It's inflation driven. Even though we could have massive deflationary cycles in a recession, the only way to support our bond market is to mouse click more money to support that. That's going to be inflationary. That is going to lose faith and trust in the dollar inside the states, inside the U.S., just like it's already been lost outside the U.S. And the solution to that is to be your own bank, have your own gold-backed currency, buy your own physical gold. I hate to say it. People say that's just talking your book. That's talking your bias. Yes, it is talking my book. It is talking my bias. But my bias is a conviction. I'm not going to wait for the Fed to have a gold-backed dollar. I'm going to have my own gold-backed dollar by buying physical gold as insurance against dying currencies.
What do you say when, I'm sure you hear the pushback, well, if that's the world we're going to be living in, how do you know they're not going to come and confiscate your gold? Because they're going to need that gold.
Look, that is something that's true. I mean, physical confiscation is unlikely. There could be tax ways to confiscate that gold through tax. We'll have to wait and see. That's a concern. That's why most of our clients and myself hold my gold physically in private vaults outside of the banking system. Most people who buy gold don't hold it in their own jurisdiction. They don't hold it in their own country. They don't hold it under their bed for a reason. I can't predict what every rule will be. I don't see a 1930s outright confiscation where folks come in black sunglasses to your house and take the gold out from under your mattress. I think there's going to have to be a point where the world realizes you can't keep playing this lie to us with fiat money. You have to support and you got to collateralize your fiat money with some form of gold. And I do believe that those who've been foresightful and prescient now in buying physical gold, not ETF gold, not bank gold, will get the last laugh because the world is turning away from fiat currencies.
Let me ask you this then. Why is crypto not the solution? Or maybe it is alongside gold. Why isn't it crypto for you?
Many people.
And by crypto, let me be specific. Bitcoin. Why is it not Bitcoin for you?
Look, I obviously have a massive bias towards gold. And I could have, and I can choose crypto as well. And there are many smart people who believe in both. Ronnie Sturfla is one of our advisors, talks about crypto. Lawrence Leopard talks about crypto and gold for a lot of the same reasons. I have a lot of respect for the intellectual argument and the technology and the blockchain behind crypto. I don't have to be pro-gold and anti-crypto to have a point. I don't think it's a zero-sum game for me. What concerns me about crypto is what I respect about crypto. Crypto is an existential threat to a fiat currency like the US dollar, which is why central bank digital currencies is another way to eradicate that crypto threat politically in the name of national security, the name of a financial emergency. I think crypto is almost too smart for its own good, just like gold is too historical for its own good. It's right in front of our faces. The solution's right there. I think there's a simple fact is, though, that there's a reason central banks around the world are buying more gold and not more Bitcoin. Bitcoin, to me, doesn't have to fail for me to feel good. I'd love to see crypto owners and Bitcoin owners get the last laugh. I think they're under the microscope and under the crosshairs of governments around the world, especially the U.S. It's a threat to have crypto threaten the U.S. dollar. They'll say it's used for money laundering, sex trafficking, arms trading. They'll come up with even environmental concerns because of Bitcoin mining. They'll come up with any reason they can to stop this Bitcoin train. I hope they don't succeed. Yeah. I have chosen myself to pick an asset that's been around for thousands of years and has always bailed out failed currencies. It happens to be, for me, physical gold. It's not nearly as sexy in price moves or standard deviation or volatility is Bitcoin. But I'm not here to laugh at Bitcoiners or to make fun of them. I personally choose physical gold. It doesn't give me the same alpha when it's ripping as Bitcoin, but it also doesn't tank as fast when markets tank. And by the way, if markets have a bad moment, which I foresee them to have, gold can be very sympathetic because it's one asset that investors can sell for liquidity. But I think gold will have a massive up and to the right historical move when we have the next market crash. But there can be periods where gold can go down, and Bitcoin as well.
Matthew, I feel like I could keep going and going. I promise I'll wrap on that point. When you said you feel that markets could be having a bad moment, what does bad mean for you? What kind of what are you talking about there in terms of percentage points?
Look, I believe in mean reversion. It's one of the most important forces in the market. It's one of the most ignored forces. All markets revert to their mean. When they go up too high, they revert back to their former means. When they go too low, they bounce back up to their former means. We're at a massively inflated risk asset market in stocks and bonds. I think, already, if you just look at mean reversion, you can see an S&P well below 3,000 when we have another credit event or another moment in the markets. There are any number of needles pointed at this debt balloon. You could call them black swans. You could call them needles. Some are predictable. Some are unpredictable. How far the wars escalate in Asia or in Russia or the Ukraine, how far this financial war gets to a tipping point. If Guise comes out with a very important gold-backed currency exchange that becomes such a threat. Will we escalate war or will we cooperate? Will we go crazy or will we go cooperative? Will there be another banking crisis? Will there be a counterparty risk in the derivative markets? Will there be a spike in interest rates because of the lack of foreign demand in U.S. treasuries? There's any number of credit events that no one can predict with perfect timing. But I think it's very clear to most of us, one of the reasons the markets are up right now is because we had this backdoor QE through other central banks QEing each other. So Powell didn't have to pivot too soon. But I think the real reason Powell's been raising rates and trying to tighten the balance sheet, which didn't really work all through 2022, was the same reason he did it in 2018. He sees that these markets are way overvalued. He sees a recession coming. He's going to engineer that recession. He's taking away the punch bowl for now. When the markets revert to their mean well below 3,000, we're looking at 50%, 60% falls from their highs easily. That's just mean reversion. That's not doom and gloom. That's just market cycles in markets that are no longer supported exclusively by a central bank. When that happens, Powell will then start reducing rates and start, printing more mouse click money to keep that all important yield under control in the treasury market, because it's a matter of survival, not of debate, to keep American IOUs, U.S. treasuries at a certain price level so their yields don't spike and we can't afford our debt payments. So it's just a question of when, and it's a mug's game to say when. I see a major mean reversion in the markets. Now, again, you can argue with a central bank mouse clicker, you can print enough money to keep markets from ever going down. Just keep buying and buying and buying U.S. treasuries, keeps rates low, and keep putting liquidity into the markets. But you do that at the expense of your dollar. So it's either death by inflation or death by recession. Pick your poison. We're in a corner now. The Fed is in a corner, which will be a corner they have either an inflationary solution or a depression, recessionary, deflationary solution, followed by more mouse-clicked inflationary solutions. It's a vicious doom loop. It just is. This is math and cycles. And that, by the way, will be the backdrop, the rubble, the setting, the smoking rubble of our economy, which will usher in the pretext for the new miracle solution, central bank digital currency. It's for your own good. Trust us. We're the Fed. Go. We've got your back. Sadly.
Fascinating insights. Matthew, to say I enjoyed this interview is a huge understatement. I loved it. Thank you so much. Come back. Now that I found you, it's over.
Oh, thanks, Daniel. I can't wait to be back. I love talking about this stuff. It's my pleasure.
Well, I could tell the passion. You see it. Yeah. Thank you, Matthew. And thank you all for watching. We'll have more great content heading your way, so be sure to stay tuned to the Daniela Camboni Show. And don't forget to sign up to stay on top of all of this at danielacamboni.com. That's it for me. Thanks for watching.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.